Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so today we are tackling a company that feels like it's suffering from a split personality. I was going through the research you sent over, and honestly, if you just look at the headlines, it looks like a disaster zone, revenues dropping, losses are widening.
Right.
But then you look at the stock price behavior, the balance sheet, and it's telling a completely different, almost optimistic story.
It really is a classic case of mixed signals. And if you're just scanning the surface level earnings reports, you see red flags everywhere.
Everywhere, yeah.
But if you dig into the filings, which is what we do here, you see a company that is, well, fundamentally ripping up its floorboards to build a completely different, much stronger house.
Well, let's get into that renovation project. We're talking about BigBear.ai, and usually when I see a company report a revenue drop, I get nervous. For the third quarter of 2025, they brought in $33.1 million. That's down roughly 20% year over year.
Yeah, big drop.
In almost any other context, a 20% revenue drop sends investors screaming for the exits. Why didn't that happen here?
Because the market, or at least the smart money, understands this is what we call a transition phase narrative. You have to ask why the revenue dropped.
Okay.
They didn't lose customers because the product was bad. They effectively fired them.
They fired their customers. That seems like a bold strategy for a company trying to grow.
In a sense, yes. They're actively shedding legacy contracts. Think of it like pruning a tree. These were low-margin, heavy-lift contracts that just didn't generate enough profit.
So they weren't worth the effort.
Exactly. They're trading volume for value.
Yeah.
They're aggressively pivoting away from that low-margin work toward high-margin, government-focused AI. So yes, revenue is down, and the operating loss doubled to about $21.9 million. That looks ugly on paper.
It looks terrible on paper. Doubling your operating loss is usually a death knell. It suggests you're spending way more to make way less.
Usually, you would be right. But here is the pivot point that the headline readers missed. Despite slashing that revenue and taking the hit, they actually beat analysts' expectations.
Oh, really?
The street was expecting $31.8 million. Big Bear delivered $33.1.
So the bar was set incredibly low, and they managed to step over it.
They stepped over it. And more importantly, management raised their full-year guidance for 2025.
Did they now?
They're now projecting revenue between $125 and $140 million. When a company with bad earnings raises guidance, you have to pay attention. It means they see something coming down the pipe that isn't fully reflected on the books yet.
And I assume that something coming down the pipe is the acquisition everyone is buzzing about.
The Ask Sage deal. This is the cornerstone of the bullish thesis right now. They acquired Ask Sage for roughly $250 million. Now, this isn't just a bolt-on feature or a small acqui-hire. This is an engine replacement.
$250 million is a huge price tag for a company of this size. What exactly are they buying for that kind of money?
They're buying decision dominance.
That sounds like marketing speak from a brochure. What does that actually mean?
It does sound buzzy, I know, but in the defense sector, it's a tangible deliverable. It means providing AI that lets military commanders process massive amounts of information and make decisions faster than the adversary.
Got it.
Ask Sage brings a pipeline of about $250 million in potential contracts. And for 2025 alone, it's expected to bring in $25 million in annual recurring revenue.
Okay, pause there. Recurring revenue. That's the magic phrase, isn't it?
It is. That's the high margin stability they were missing with those old legacy contracts. Instead of doing a one-off project, they're selling a subscription to a capability.
And that's why they're confident enough to raise guidance. So they bought a revenue engine. That explains the optimism on the future numbers. But let's look at the checkbook. You mentioned a $250 million acquisition. Usually when we talk about small cap AI companies, the story is great tech, zero cash, drowning in debt. Is Big Bear in that boat?
This is where the story gets really surprising. If you asked me a year ago, I would have said, yes, be very careful. But right now, the balance sheet is arguably the single strongest component of the bull case. It's a fortress.
Fortress is a strong word for a small cap. Back that up with numbers.
As of September 30, 2025, they were sitting on $456.6 million in cash.
Wait, nearly $500 million in liquid cash. for a company with a market cap of, what is it today?
Around $2.6 billion. So that cash position is massive relative to their valuation. It creates a tremendous safety net. It gives them a runway for R&D, for integrating Ask Sage, and crucially, it means they don't have to go out and raise cash in a panic when the market is down. But there's a detail that's even more important than the cash pile. It happened just recently, on January 16th.
You're talking about the debt restructuring.
The debt catalyst. This was a critical strategic move. They handled a major note redemption. Essentially, they converted $125 million of convertible notes into stock, about 38 million shares.
Okay, for the listeners who aren't CPAs or deep into finance, break down convertible notes quickly. Why do they matter?
Think of a convertible note as a loan that has an eject button. The lender gives the company money, and the company pays interest, usually quite a bit. But under certain conditions, that loan can transform or convert into shares of stock.
So instead of paying back the cash, you hand over equity.
Precisely, which wipes out the debt instantly.
And the result, staggering. Their total debt dropped from $142 million down to roughly $17 million. Just like that, they eliminated about $7.5 million in annual interest payments.
That is a lot of cash flow freed up. That's money that can go to engineers instead of bankers. But I have to play the skeptic here.
Please do.
They didn't pay that debt with magic. They paid it with stock. They printed 38 million new shares. That's dilution. If I'm a shareholder, my slice of the pie just got smaller. Why should I be happy about that?
You're absolutely right to push back on that. It is dilution, and shareholders took a hit on their percentage of ownership. There's no sugarcoating that. But you have to look at the risk-reward trade-off.
Okay.
By converting that debt, the company is now significantly de-risked. They don't have that massive debt wall looming over them anymore. Their debt-to-equity ratio dropped to a very healthy 0.18. They've effectively moved to an equity-funded growth model. So the argument is, I'd rather own a slightly smaller piece of a healthy company than a bigger piece of a company that's drowning in interest payments and risking bankruptcy.
That's it, exactly. It cleans the slate. It takes the bankruptcy risk card off the table almost entirely. For a growth investor, that's usually a trade worth making.
All right, I'll grant you the financial health is better than I expected, but let's talk about the product. AI is everywhere.
It is.
I can open ChatGPT on my phone right now and ask it to write a poem about a toaster. Why does the U.S. government need Big Bear? What's preventing the Air Force from just getting a ChatGPT Enterprise subscription?
That is the multi-million-dollar question, and this is where we talk about the competitive moat. And it comes down to 3 words. Government-grade classified AI.
Meaning what, exactly?
Meaning data sovereignty and security clearance. You cannot upload classified troop movements, satellite reconnaissance, or sensitive health data into a public cloud or a generic large language model.
It's a national security violation.
It is. Ask Sage is a secure generative AI platform. It's built specifically to handle classified data within the government's restricted networks.
So the barrier to entry isn't just the technology, it's the red tape.
The red tape is the moat. To even bid on these contracts, you need specific compliance architectures and security clearances that take years to obtain.
Right.
OpenAI and Google are fantastic, but they aren't necessarily set up to handle top-secret SCI workflows out of the box in the way a specialized contractor is.
And once you're in, I imagine it's hard to get kicked out.
Incredibly hard. We call it stickiness. Imagine you're the U.S. Space Force, one of their clients, by the way. You build your mission workflows, your daily briefings, your decision trees around Big Bear's analytics.
You can't just rip that out.
You can't just rip that out and switch to a competitor overnight. The switching costs are massive.
Speaking of clients, I saw something in the research about the New England Patriots. Are they pivoting to football analytics? Because if they can predict the Super Bowl winner, I'm all in.
Not exactly pivoting, and unfortunately no Super Bowl predictions yet. But it is a fascinating proof of concept. They have a partnership with the Kraft Group, which owns the Patriots.
Okay.
But they aren't analyzing quarterback stats. They're using their AI to create supply chain transparency for a company called International Forest Products.
Timber and paper, that seems like a far cry from Space Force strategy.
It does.
Yeah.
But think about the complexity. And this is crucial because it answers the TAM question, the total addressable market. It proves that their defense-grade AI can translate to industrial use cases. If you can track assets for the military in a chaotic war zone, you can certainly track timber for a global supply chain. It signals that their market isn't just the Pentagon, it's any complex global logistics operation.
It's basically saying, If it's robust enough for national security, it's probably good enough for your warehouse.
That is the pitch. And if they can scale that commercial side, the ceiling for this company gets much, much higher.
Okay, let's shift gears and look at the charts. Fundamentals are one thing, but price action is truth. For the traders listening, where is the stock actually trading right now?
So looking at the technicals, we're hovering right around the $6 mark. The recent range has been roughly $5.94 to $6.31.
And how does that look compared to the broader trends? Is it breaking out?
It's precarious. We are currently trading below both the 50-day moving average, which is at 605, and the 200-day moving average at 642.
And for those not glued to charts, being below the 200-day average is usually the definition of a long-term downtrend. That doesn't sound bullish.
It's not bullish in the short term. Technically, the stock is broken right now. However, if you look closely at the volume, there's a pattern emerging that looks a lot like a capitulation setup.
Define capitulation for us. I hear that word thrown around a lot.
Capitulation is when the last of the weak hands give up. It's panic selling. We're seeing high volume on the down days. Volume is spiking 40 to 60% above average when the price drops. This suggests that the frustrated investors who've been holding on are finally throwing in the towel. They're selling just to get out. Historically, when you see that kind of high volume washout, it often marks the bottom.
The sellers run out of ammunition.
Exactly. Because everyone who wanted to sell has sold.
So the tourists are leaving. Who's left? What about the smart money? What are the big banks and insiders doing?
This is where we see a massive divergence. It's actually quite confusing if you don't look closely. On one hand, you have analysts like H.C. Wainwright maintaining a buy rating with an $8 target.
Okay, so that's pretty bullish.
That implies about 35% upside. Some quantitative models like BigBear.ai are projecting an upside all the way to $9.38.
That's a huge spread. $6 versus almost $9.50.
It is aggressive, but then you look at ownership.
Mm-hmm.
Insiders have been doing some selling. The CFO and a director sold shares recently, and total insider ownership is very low, around 0.54%.
That is worryingly low. You want management to have skin in the game. If they aren't buying, why should I? What about the big institutions? The Vanguards and BlackRocks?
Also surprisingly low. Institutional ownership is only at 7.55%.
Wow. Usually, these hot AI stocks are packed with institutional money. 7% is virtually empty. That sounds like a red flag.
It can be. But in this specific context, I interpret this as dry powder.
Meaning?
Meaning the big funds haven't bought in yet. They're waiting on the sidelines. Think about it. If institutions already owned 80% of the stock, there's no one left to buy. The trade is crowded.
Ah, I see.
But it's 7%. If the turnaround story starts to click, if they deliver on that earnings guidance, there's a massive amount of capital that could enter this stock. The room for a rally is huge because the room isn't crowded yet.
So if the big boys decide to come to the party, they have to buy their tickets from scratch, which drives the price up violently.
Exactly. It's a vacuum waiting to be filled. But they need a reason to enter.
So if we're looking ahead, what should we be marking on our calendars? What are the catalysts for the next 3 months that could trigger that buying?
There are 4 key things to watch. The first one is happening literally right now, January 21st and 22nd. The shareholder vote.
What are they voting on?
They're voting to increase the number of authorized shares from 500 million to 1 billion.
1 billion shares. Hold on, we just talked about how they printed shares to pay off debt and how I didn't like the dilution. Now they want permission to double the share count.
I know.
That sounds like a dilution bomb waiting to explode.
It sounds scary, and it is a risk. But it's expected to pass with 97% approval. The company argues it's about flexibility. They want the ammo to do future M&A, maybe buy another company like Ask Sage without using cash.
So they might not even use them.
Just because they authorize the shares doesn't mean they'll print them tomorrow. But yes, as an investor, you have to accept that the long-term dilution risk is real. They are building a war chest of paper.
Okay, so that's the vote. I'm not thrilled, but I get the logic. What's next?
Number 2 is Q4 earnings, likely in late February. This will be our first clean read on the Ask Sage integration. We need to see if revenue stabilizes above that $33 million mark.
I need proof of life.
We do. Third is the government budget. We need to see specific contract wins materialize from that $250 million Ask Sage pipeline. Rumors are nice. Signed contracts are better.
Show me the money.
And finally, macro. Defense spending tailwinds. Geopolitical tensions are high, unfortunately, but that usually leads to increased budgets for defense tech. If the defense budget grows, Big Bear's TAM grows with it.
Sad but true. Okay, I'm feeling pretty optimistic hearing all this. The cash, the niche, the clear debt. But my job is to worry. What could go wrong? I saw Cantor Fitzgerald downgraded them recently. Why?
That is the bear case, and it is real. Cantor cited execution risk.
Explain that.
Basically, the Ask Sage deal is a bet the company move. Mergers are notoriously hard. If the integration fails, if the cultures clash, or if the technology doesn't mesh with their existing platforms. They've burned a massive amount of capital for nothing.
Right.
They paid a premium for potential. If that potential doesn't turn into profit, they're in trouble.
And I heard something about lawsuits.
Yes, litigation risk. A law firm called Pomerantz LLP is investigating potential securities fraud regarding that revenue decline we talked about earlier.
Is that a deal breaker?
It creates headline risk. It hangs over the stock like a dark cloud. Often these things settle for pennies or get dismissed, but in the short term, it makes conservative investors nervous.
And then there's the dilution we talked about.
Right. The note conversion plus the share authorization vote. The slice of the pie is getting smaller. If the company's growth rate doesn't outpace the rate of dilution, the stock price will stagnate or drop, even if the company gets bigger.
So bring it all home for us. When you weigh the Fortress balance sheet against the execution risks and the dilution, what's your final verdict?
When I look at the whole picture, I give BigBear.ai a bullish score of 7.2 out of 10.
7.2?
Yeah.
That's a confident score for a company losing money.
It's a solid score for a turnaround play. This is a balance sheet-driven story. Eliminating that $125 million in debt is a game changer. It takes bankruptcy off the table for the foreseeable future. This is a high-beta AI play trading at a discount.
So what's the strategy for the listener?
It's a show-me story. I wouldn't chase it if it spikes tomorrow. A good entry point is accumulation between $5.50 and $6.
Okay.
If the thesis plays out, if they land those contracts, I'm targeting $8 in the medium term, say, over the next 12 months.
So patience is key. Pick your spot, wait for the contracts to roll in, and watch that earnings report in February like a hawk.
Don't buy the hype, buy the execution.
Love it. Well, that wraps up our look at BigBear.ai. If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps us out.
Thanks for listening.
See you next time.